Don, so what do you think the right takeaway is here? Is the right takeaway to focus on Texas Instruments as a barometer for what's going to happen to the broader market, stocks that are going to bounce?
No question about it. Texas Instruments is just a symptom of a much larger dynamic going on here, which is, once again, we've come into an earnings season with low, bearish, awful expectations, and once again, the earnings have just blown them away. You know, I look at forward earnings, consensus forward earnings from all the Wall Street analysts. I get them every day, and I aggregate them together and cap weight them and come up with an S&P 500 consensus forward estimate. That estimate today on an annualized basis is 15% higher than it was a month ago. Earnings are just going through the roof, and that's why stocks are at new highs.
Texas Instrument and GM are two much more interesting stories. When you look at Texas Instrument, they're selling into a market that's no longer price sensitive. Everybody gets cell phones. They're essentially free with a 2-year contract, so it doesn't matter. GM, on the other hand, look, we saw car sales were down 8% last year. So far this year, they're down 2.5%. That's going to continue. It's very apparent that with a diminished ability to pull cash out of the home, car sales are going to be under a little bit of pressure.
Don, it seems to me, though, I mean, this was sort of a statement of the obvious, wasn't it? I mean, we would expect, given some of the issues in housing, you would see some of this in car sales.
No, General Motors doesn't have an issue with housing. The subprime blow-up doesn't explain their numbers last year. What explains their horrible numbers for the last 3 or 4 years?
So you think they're just using it as a crutch?
Are there horrible cars?
So they're using this as a crutch. They're making it up.
Well, they're not making it up. They're just making up an excuse. If you were the CEO of General Motors, what would you say? Would you come on CNBC and say, I make crummy products, or would you say, blame the mortgage industry? You'd say, blame the mortgage industry.
But Don, is it true, though, that weakness, pronounced weakness, in both housing and in auto manufacturing is already fully discounted in this market, and therefore it is time now to be bullish overall?
It's not only discounted in the market, it's discounted in the economy. If you take those two factors out of the economy, in fact, just take housing out. The economy grew every quarter last year at fantastic rates if you just take the wild card of housing out. The question here is contagion. It doesn't take a genius to see that housing is slowing down. It doesn't take a brilliant person to see that autos are in trouble. The question is this infecting the rest of the economy? The bears keep saying it will. They keep saying it. They keep saying it. They keep saying it. And it never happens, and it's not going to happen because the rest of this economy is incredibly vibrant, as Texas Instruments proves.
He has a point. He has a point. I mean, we haven't seen it spread yet.
Well,
we've been hearing about subprime slime for months.
Well, we've been hearing that about months. Let's look at the rest of the earnings that we've seen out of the 800 stocks that Dow Jones follows. You know, you see a huge increase in energy and a huge increase in financials. If you back those two sectors out, the rest of the earnings picture is negative 3.5%. So it is starting to impact. It's impacting consumers. It's impacting business capex. Today, the National Association of Business Economics had come out with a report, and it was generally very, very cautious. And there's a reason for that. CapEx spending is down. Consumer spending is starting to move more to credit cards. People are taking on more and more debt. Eventually, those chickens come home to roost.
Please, please. Who among the bears wasn't saying all this same stuff 3 years ago?
I can't talk about everybody else. I can only talk about what I'm saying, Don.
And the housing bubble. I mean, when
I never said there was a housing bubble, Don. That's not me. I'm not in the housing bubble camp.
And the trade deficit and offshoring and all the other things that all the bears all get together and they all have been saying for the last 4 years of this bull market. It's been wrong for 4 years and it's wrong now.
Well, let's get the bookend set here. Here's what I want to know, Barry and Don. Barry, you're talking about bearishness on U.S. markets.
Yes.
How low do we go here in the U.S.? What's your major correction? 5%, 10%, 20%?
We haven't seen a 10% correction in 4 years on the Dow or the S&P. If you look back to a period of history that's not perfectly analogous, but close. If you look in the 1970s, inflation was much higher, growth was much lower. We saw 5 corrections of about 30%. Maybe we won't see that big of a correction, but it's not historically unprecedented. And what's most important for investors to realize is what you get paid for your risk relative to your reward isn't as great as it was 3 or 4 years ago.
So you're saying 30% down is possible?
That's certainly within the realm of possibility. That's the historical average of major corrections anytime you're near a recession or a major earnings failure.
All right, Don, so that's the yin. Give me the yang. How high do we go this year?
Okay, here's the yang. In January 2006, Barry Ritholtz was not just saying it was in the realm of possibility. 30% down was his official prediction for year 2006.
After the rally, after we saw 12,000 and 2,600 on the NASDAQ.
Barry,
absolutely.
Just admit you were wrong. Stop talking about this rally. The fact is, you told TheStreet.com and you told Business Week that your 2006 price target on the Dow was 6,800.
Now,
are you denying that? Are you denying that? Are you
Absolutely
denying
not.
that?
Don,
Yes or
absolutely
no?
not. I said
Okay, so here you are, the
2,600 and then a
broken-
30% correction.
You know what,
Neither
Barry?
happened in 2006. but
You've
it's
done an
still a
amazing new
possibility.
thing. Most broken clocks are right twice a day. You're a broken clock that's wrong twice
Don,
a day.
you tell
here you go
half
with
the
this
story all
30%
the
stuff
time.
again.
You know that's not true. Every time you go on your website and you mention he was bearish here, you never turn around and say 2 months later he flipped bullish. On this show,
Did
I've
you
been
predict
bullish.
Dow 6,800 for the end of 2006?
I
Yes or
predicted
no?
Dow 11.8 and
Okay.
6,800 for the same year. I said volatility
So you
was
were
returning.
wrong. In other words,
Absolutely,
you
that was-
were wrong.
Absolutely,
You
I
were
was
wrong.
wrong.
Okay.
That's
You
100%
were
right.
wrong.
I was wrong. Like all forecasters are wrong.
All right,
Forecasting
Don.
is folly.
Don,
and
we
you
got to
know
take
that,
a break.
Don, as
So
well as
give me
anyone else.
an upside target before we go. One word. How much up?
Another 5% on the S&P.
Oh, that is hardly bullish. Okay, we're going to take a break.
We like commodities a lot. We like gold because we think inflation continues to be a problem. We like any of the energy-related stocks, be it coal or nuclear or oil. And we continue to like any of the agricultural materials stock because they're exporting to China and Asia. That's where the big boom globally is taking place.
Don, you said you're looking for 5% for the market overall this year. Do commodities beat that significantly?
Yeah, I guess even a blind pig catches a truffle every once in a while. I agree with Barry 100% on everything he just said.
You guys are out of control tonight. Yeah, all right.